Good morning, everybody. I make it 11 o'clock here in Cape Town. A pretty wintry Cape Town, I have to tell you. I'm sure the Cape Townians on the call empathise with me. It's been a bit of a fresh one this week, but welcome to everybody, wherever you are around South Africa or around the world, to the Denker Global Financial Sector and Fund Update. Thank you for joining us. There are a few more participants, I'm sure, coming online over the course of the next few minutes. If I could ask everyone just to make sure that your videos are switched off and you are on mute, just to save our bandwidth and keep the sound under control, that would be great. You can see the opening slide here, which sets the scene for today, running back to the original call that we did on the sector back in March, which we were very close to the bottom in terms of sector performance at that point. And I'm very pleased that we have the team with us again. I'll click on to the next slide, Cocky. Barry, Ben and Craig. Cocky, most of you will, I'm sure, know and have heard speak many times before. Barry, Ben and Craig are the equity analysts within the team, and you can see their various responsibilities under their names there in terms of the components of the sector that they cover. So we're going to hear from everybody today. What I'm going to ask is that when you're speaking, if you could please put your video on so that we can see you speaking. And if there are any questions, I'm happy to try and field those through the chat box as we go along. But I think often with this, we've got a lot of people on the call, so maybe it's better to handle those towards the end or email them to me. And I promise you we will, during the course of the day, come back to you. So if we can handle questions in that way, that would be great. Okay, Cocky, I hope you can hear me and you're online. I'm going to ask you to switch your video on now and to pick up here on slide number 3. Cocky, are you with us? I know you're with us, but can you...
Nigel, yeah, no, thank you very much. I think the most important thing is one can see on this slide how the markets reacted strongly to the fear of the COVID-19, and secondly, I think what is very important is, and you can't see it totally here, but the financial index fell more sharply, and in fact our fund fell even more because of we've got a smaller cap and emerging market bias here. But I thought back to 30 years ago when Jonas van der Horst sent me out to Asia to go and look at the Asian tigers, and with Terence Moll at that stage, and we looked at the Asian tigers, Thailand, Indonesia, and those countries then, and we visited all the banks, and you could see the asset bubble coming. There was injudicious lending. And so it was no surprise when Asia fell over then. Similarly, in 2006, 7, 8, I remember having endless arguments or discussions with guys like Francois Gous, and we were arguing this cannot last. You could see the bubble building in the US, and in fact, in 2008, end of 2008, we had only 4% invested in US banks. What is important in this crisis this time is that we entered the crisis, if you want to call it the crisis or the recession, with the banking system very strong. And in fact, lending over the last 5 years, generally, but specifically in the US, in Europe, and in South Africa, was anemic. Barry and Ben and Craig have been pulling the numbers for me, but on average lending growth was less than 3% in cases. Okay, there was still a selling off of portfolios, but banks went into this crisis very healthy. And so what really the message we want to get across today is that the market has overreacted. It's replaying its 2008 fears, and specifically when it comes to the bad debts, when it comes to the capital position of banks, and also in terms of the ongoing lending, the market actually has just got it wrong, and that's arrogant to say it. But we'll try and bring across this morning as to the number of managements that we've been interviewing via Zoom calls and the feedback we've been getting from them. And they've also obviously seen what they can see, but we've also been stress testing what they say against 2008 and other crises. And each time we come back and just say, the market has overreacted. It doesn't mean to say that the market sees its error, but we know that in terms of valuations, the valuations on our side, so your downside in terms of where you are on the valuations is very low. So, and that's in the previous presentation, we used the same terminology. Charlie Munger always talks of the so-called, in baseball terms, the fat pitch, which means when a batter gets a ball pitched to him that is of poor quality when it's pitched, and it gives him confidence to really strike out hard and hit it out of the park without a lot of risk of mishitting. And we've had a bit of a bounce. Yesterday, fortunately, markets came back, gives us another chance, but we still think maybe not quite the fat pitch that you saw in March, but the field is still allowing us to hit a lot of fours and maybe even a few sixes, but we'll come back to that later. I think the point here is you can see that the markets fell sharply and have strongly as well, but the financial sector has lagged because of all this about bad debts. And maybe just a warning here, there are a few slides in the presentation that are quite technical, and it's the only way we can convince you that there is an opportunity here. Okay, Nigel, if you go to the next one.
Okay, yeah, maybe sorry, Cocky,
this is crucial.
Cocky, just interrupt you. Maybe you could just switch your video off. You might improve your sound quality if you switch your video off there. Keep your sound on, obviously. Just try that.
Video off. Okay, let me. Good idea.
There we go. See if that improves things.
Okay, we'll see if that works. But this slide came from Morgan Stanley in early April, and we used the previous presentation as well. What is so important to understand in this recession is that the recession was caused by governments closing the tap. And so logically, you'd suddenly see a lot of unemployment, especially what they call in the US the hourly paid workers. But you always knew as the governments would switch on the tap again, the economy would restart. It's not like a normal recession, which was always triggered by injudicious lending and asset bubble, valuations being too high, and then the central bank is interest rates to kill the recession, to kill the upturn, and then it all depends on when confidence comes back as to when the recession ends. In this case, the confidence returns when the government switches the tap on, which has happened. Now, what is important here on this slide is obviously for each country, the slope of the right-hand leg of the V is going to differ. So the US, because of what the Fed has done, because of what the government has done, the slope most probably will be sharper or quicker than, let's say, in the UK, where they are still battling with a lot of things. And like countries like South Africa, Brazil, India might see quite a longer bottom, almost a U, and a slower upward sloping V, simply because the weak position, countries like ourselves and Brazil entered this problem. But the US has done a lot and has actually helped the world as well. And incidents that 23 March, when markets bottomed, was actually the day, 22 March, when the Fed said basically they'll do what they can and they're going to fire the bazooka, keep firing the bazooka until we've normalized. So I think to bear in mind how long it will take to get back, and I don't think it looks like 2, 3, some say 5 years to get back to where we were in terms of GDP, level of GDP, but slowly, gradually, there will be a recovery. And so essentially, I've explained that the slide. We can actually skip it. Maybe just one point here is that regarding the bank sector, what is misunderstood as well. The bank sector was never, and the insurance sector was never shut down. They actually continued working full time, and in fact, especially in the US, but also Europe and here in South Africa, a lot of bank teams have been working harder than ever. Simply to process all in the US, the PPP claims. The government used the banks there as a tool to dispense aid to SMEs and to other corporates. Larger corporates have all been drawing down their facilities to make sure they have enough cash on hand. So bank teams have actually didn't have a COVID break at all and have been working very hard, and actually will come out of this crisis with an even greater need for funding. If you just think of your own or any businesses, the revenues have dried up or have fallen significantly in most businesses, but the expenditure remains. So you actually had needed credit. And so the bank sector has been providing that credit and will have to keep providing that. The risk, obviously, is how many of those businesses that they've been providing credit to will make it, but that is what we'll try and unpack in the slides to come. So yes, we've had a lot of questions on South African banks, and we do actually manage the Net Group or Nedbank Investment Financials Fund. It's a South African financials fund, but the topic today is more global. But because of the questions, we thought just quickly to tackle South Africa. The World Bank projects our economy could rebound with 2.9%. That would be very, very poor growth compared to what other countries in the world will show. And I actually, the little block at the bottom, you can see there that the recovery could gain further traction if planned structural reforms are implemented, and especially regarding the private sector. And I saw Miles Ruck is also on the call. Hey, Milo, thank you for joining us, but you got to speak to Cyril, you got to speak to Jacko. You must get this point across, but if we don't involve the private sector, and we're all in agreement because you all are capitalists, else that's why you're listening to this call. But we must really hope and that the government and Cyril, I think, knows that, but that he gets the people around him to really use the private sector, both in terms of its expertise and in terms of its capital, and in terms of its willingness to help to really grow jobs again. But maybe just specifically on South Africa, all our interactions with bank management so far show it's very unlikely that any of the listed banks, I can't speak for the unlisted, but I'm sure they're just as strong, will generate losses in 2021. Believe it or not, the banks will still be profitable, and we'll show you later how bad debts have to get for the banks to report losses. And it can happen. You could have a very large group somewhere falling over, but so far we haven't seen that. True, as you'll see later in the presentation, there is a lot of margin pressure, and that is the sad outcome of COVID-19. Well, good for the banks, but sad for economies, that we've seen almost every bank we speak to, a rapid increase in digitalization. So this might just kill branches as we know them finally. Well, it won't obviously, but it will accelerate the demise of branch banking. So, and that obviously is going to bring with it job losses. But for the banks, it means that operating efficiencies are going to be a lot higher. So you're going to see a lot of head office staff disappearing. You're going to see a lot of branch staff disappearing. And we'll show you later in a slide that generally banks where you've had negative real interest rates, they've made up for the margin pressure with cost efficiencies. So, yeah, and I think the point we make here on the Net Group Fund, and it's the same for our global fund, people tend to think of the funds, a financial fund as a bank fund. It's not the case. Obviously, it's very diversified. I think that is the next slide, which I think Barry and Craig will talk to. Oh, sorry, just this one. Yeah, on the PEs, just to show banks in South Africa have actually fallen a lot in terms of valuations and PEs. And I just thought it's interesting to compare First Rand to Banorte and Ito. Those are most probably the three best managed banks in the Southern Hemisphere. I'd most probably, yeah, in fact, I don't have to go into that, but they're very good banks. And you can see these are three economies that sort of have been the worst hit simply because of the leftist leaning of the government. In Brazil, it's actually not leftist leaning. It's Bolsonaro who's just, let me not criticize people here, but his handling of the crisis has been very, very poor. But you can see there that Brazilian banks, Mexican banks, and South African banks trade more or less on the same forward 21 PE. We just took 21 just to get over 20, which has a lot of uncertainty. And then you can see the difference between, let's say, First Rand and Nedbank, and that is the same for banks and for countries. The stronger you entered the situation, the more you're going to benefit relatively. Nedbank has been smashed because of its perceived high exposure to commercial real estate. Mike Brown assures us that that exposure is not as bad as the market thinks, and the loan to values are 48%. Okay, maybe it won't be 48%. Maybe it will be a lot higher because the values have come down. But that's the market perception on Nedbank at the moment. And again, I think the market is wrong. So I often get asked the question, South Africa, what would you buy now? Well, if you're a high-risk investor, you'd go for Nedbank because that's obviously the most re-rated if the market is proven to be wrong. Okay, Nigel, I think the next one we can hand over to
to Barry. I think Barry, are you just gonna take us through the makeup of the fund, because the perception is that it's just a bank's fund, but do you want to just open up a little bit more around the detail of the fund exposure for us?
Yeah, sure. So morning everyone, thanks for joining. As you can see, exactly as Nigel says, the fund is a lot more than just a bank's fund. A big portion of what the fund is, more than a quarter, is the insurance sector. As many of you who've listened to us before, who've met before, will know, the majority of that is made up of North American non-life businesses, which we think they add a good defensive profile to the fund. And they tend to be driven, or they are almost entirely driven by the underwriting cycle. So it moves you away from the sensitivity of markets and the economy, which is largely a driver for banks. Just to answer Mark's question, P&C stands for property and casualty. So think of it as non-life, all sorts of insurance that is non-life related. So auto insurance, fire insurance, hurricanes, etc. We have actually seen some good opportunities in that sector emerge over the last few months. And that is because there's been a number of large losses over the recent years, which have put pressure on pricing. So what we're seeing there is an extremely strong upwards move in the pricing cycle for the businesses, meaning they can charge higher premiums to underwrite. One of our portfolio holding CEOs put it well on a recent call, where he said, at the moment in the industry, capital is scarce and risk is plentiful. So we tend to stick to the companies with strong balance sheets and those that can take advantage of dislocations like that. So yeah, I've been lobbying hard to increase that percentage, and we actually have. Yeah, as I said, a bit more than that. We have a few debt collectors and wealth managers, as well as a number of other unique type of financial services companies. The regional exposure, we are, as you guys would also know who've listened to us before, we have quite a heavy tilt to emerging markets, where we see stronger returns on capital and a much better longer term growth outlook. But yeah, Craig can touch on that a little bit more if you'd like to.
Yeah, thanks, Barry. I mean, essentially why we like EMs, as Barry touched on, is that they have exciting growth opportunities and are generally high return, high ROE businesses. Just a sample of emerging market Asian financials shows that the gap between them and the developed peers is around 400 basis points on average in return. So it's attractive from that sense. We believe that emerging markets will remain the drivers of global growth, and many of them are very well positioned to recover from the current turmoil. They have strong fiscal balance sheets, and a lot of them have shown a very capable way of handling the COVID pandemic better than a lot of the developed markets that we've been following. So places like Thailand and Vietnam stick out for that matter, where they've almost fully opened their economies again. So we think the financial sector is directly exposed to these opportunities as they provide the necessary funding for growth and economic development to take place. And then in terms of valuations, the sell-off that we've seen since the beginning of the year, they are trading at extremely attractive valuations at this point of view. If you look at it on a long-term price-to-book basis, relative to their own history and relative to developed markets as well. If you look at it from a Schiller cyclical adjusted PE point of view, they've almost never been cheaper. And we think that there's a clear disconnect between price and value, given this broad-based sell-off. So just to reiterate some of the points that Barry made on the P&C space, and that we like companies with strong balance sheets and that are well capitalized, we find many of these emerging market financials share the same characteristics. So this gives us comfort that they'll withstand the current environment and the expected provisions that need to come. And further to that, there's also in a risk-off environment, you obviously have the dollar strengthening. So we do believe that in some cases, because of strong fiscal positions and the positions that those countries find themselves in, we think that EM currencies in general are oversold, and this could provide further upside to our bottom-up assessment of intrinsic value already. So that's why we're excited about the EM opportunity and why the fund has roughly 30% exposure to EM and will likely continue to do so. Thanks.
The question, good question, CEE. We tend to throw around the terminology the whole time, and we forget that not everybody deals with it. We're not positive on core Europe, and in fact, in core Europe, we've actually only got 3 holdings. That's ABN AMRO, ING, and AXA, the French insurer. And but so we've tried to benefit from Europe via Central and Eastern Europe, where your tax rates are a lot lower than Europe. In fact, the tax rates tend to average 20 to 15%. The populations are younger, and cost of labor is lower, and so the growth rates in Eastern Europe are a lot higher. And so that's where the Central and Eastern European exposure comes from. Yeah, thanks, Nigel. If I can, I think I've touched on this, but let me just quickly run through the points we might have missed in the introduction. So I think the main point, firstly, each country is different, but so we have to speak generally here. But corporate credit demand has been actually good almost everywhere. In fact, Standard Bank, I said in their recent update, it's robust. A lot of it has been drawing down of facilities, and now what we see in the US actually coming through the last few weeks, that some corporates are starting to replace the bank lending they did with more bond and other securities as those markets are opening up, which shows that the Feds is doing its job. And then since May, June, we see credit card lending starting to pick up strongly in the US. And since economies have opened, almost every bank that we've listened to say that the repayments so far have been good. It is early days. You've mostly seen in the UK that Heathrow are starting to retrench staff. BA are starting to retrench staff. So there's still a second wave coming. But so far, repayments of people who ask for what is called in US deferrals, or in India they call it moratorium. As the economies have reopened, people have started repaying, where they've previously asked for a deferral. And then most indications are that Q2, this is the quarter we're in now, ending June, will still see a high reserve build. And Ben will talk about this a bit later. It's very important that the accounting regulation is totally different from where we were in 2008. Via CISL and IFRS 9, banks now have to provide immediately. So these are all provision builds. They are not actual bad debts, but Q2 will see a high reserve build, and then that should be the peak. Net interest margin, we've got a slide on that. But the point as well is, and I think that's what Barry and Craig brought across, the fund is diversified. So in fact, there are a lot of our companies that actually are benefiting from lower interest rates or not as impacted. I think the most important thing that actually really drove down share prices in Europe is when the regulators first requested, and then a lot of them actually forced banks and insurers generally not to pay dividends. And then you saw a really sharp drop-off in share prices. Now, in the case of ING, it's an interesting one where the dividend had already been declared, but so they put the dividend into a suspense account, so treated it as a creditor, did not add it back to capital. And so what they are saying, as soon as this is over, we will pay that dividend unless, obviously, the situation really deteriorates. So the central banks in that regard have been wise, telling banks and insurers, we don't know how bad it's going to get. Hang on to your capital. It would be unwise to pay it out now. And also, we don't want to be seen to be helping you to help the economy, but you are rewarding shareholders via dividends. So dividends are on hold. But the indications are that, well, Ben will tell you about US just now, but in the US, they are still actually paying dividends. But indications are 2021, we'll see a resumption of dividend payments. And then that will obviously see quite a re-rating. Now, I think I've covered this, but it's really, you can see this is just the Discover CEO, a credit card company in the US, who said, that a lot of people took 1 month and are not renewing their request for deferral of payment a second month. So I think the most important point we just want to make is 2020 is not 2008. And the market initially sold down financials as if 2020 is going to be a repeat of 2008. If there's time at the end, Barry can just talk about our mortgage insurers, Essent and MGIC, which was sold down 60%, simply because the market took a knee-jerk reaction and believed, here we go again. But 2020, also in the mortgage market, is totally different. Prices were very high in 2008. You've most probably seen or read The Big Short in terms of what was going on, in terms of people who were being offered mortgages without having the income. People were getting 3 or 4 houses and just flipping them. None of that activity was prevalent in 2020, the opposite. But yet the market sold those shares down, fearing that they would sustain similar losses. And there again, it was great to have Barry on the ground with his in-depth knowledge of those companies. And we we actually bought more Essent, and we actually added to a new holding, Arch Capital, as well, which was also really sold down. So yeah, I think the most important point is 2020 is totally different from 2008 in terms of the financial sector.
Okay, thanks, Koki. I'm going to pass to Barry again now. I know that as an analyst team, you've been doing a lot of stress testing. We've got an example here of one of the stocks in the portfolio. Would you just like to take us through some of your thinking here and maybe just use this one as a good example?
Sure, Nigel, thanks. Yeah, this is just to illustrate our process. I mean, we just wanted to put a little bit of data to the comments Koki has just been making. So this is a company that we've been adding to recently in Mexico. It's called Regional. It's a small sort of mid-cap SME lender. The share price was decimated. I think the valuation went from roughly 1.4 times book down to as low as 0.75 times from the end of last year to mid-March. What we've been doing is, I mean, we've met this company many times. We know them fairly well. We've had calls with them. And all we're really trying to illustrate in this slide is that to show for the bank to remain or to not be profitable, you have to see cost of risk go up more than 6 times from 2019 levels, or more than double its historic peak. So that's through multiple crises. The company was formed in, I think, 1998. So all we're trying to illustrate is that we really are fighting our biases internally, and really sort of we've certainly seen great opportunities where we think that capital is not going to be impaired. Of course, there's going to be an impact on earnings in the short run as bad debts will worsen. But we think in a lot of cases, the market has marked down the shares, has overreacted in how they mark down the shares. I think, Ben, you can move on to another example where he's got a little bit more detail of the principle. And yeah, of course, I'm happy to talk through that in detail offline if anyone would like to.
Okay, thanks, Barry.
Yeah, thanks, Barry. Hi, Nigel. This is just, I've taken a US bank, which it's more retail focused, so it's not as skewed by investment banking activities. Just to try and give an idea of how the new accounting treatment works. So if we look at the Q1 2020, where they took provision of 993 million, that was actually only about 300 million worth of actual bad debt, which is very similar to Q1 2019. And the rest was a COVID-19 adjustment, which what they need to do now with CECL, which means they need to take the losses they assume on their book up front. So their indications at that point when they made the provision was at an unemployment in the US of about 8 or 9%. And yeah, so they look at the unemployment as a macro indicator and then overlay that on their actual book. And that's where they then spit out with their provision to raise. So it's very difficult to forecast, and your good banks will be more prudent, and your banks maybe struggle a bit more, might play with the numbers. But US Bank was quite a solid bank. They're generally quite prudent. So when they made that assumption, as we said, Q1 would be on 8% unemployment. Obviously, at the end of Q2, who knows what the unemployment figure will be. But if it stays at about the 13 or 14% it is now, then that would be raised. And that's where I then came, my assumption was now they might raise about 1.3 million. And that obviously depends on the unemployment, but also what the stress in the actual book is. So they'll play through that. And that's why unless unemployment goes up again from 13% higher, Q2 should be the peak, because or their book significantly deteriorates for some reason. From there on, it should come down as unemployment would come down. So yeah, and even on those numbers, you can see compared to what Q1, we're still being quite negative, and we come with a total build of 3.6 billion rather than the 1.5 they had in 2019. And then, I mean, that was the points I made originally on the results day of mid-April. And yeah, just listening to the calls which management have had at the conferences now over the past week, early indicators are that perhaps these numbers were maybe too pessimistic and it could be better, but I'm not going to build it in just yet. We're still rather erring on the safe side. And that's where that 2.8 billion is maybe now a more realistic assumption. But that's just where it'll be quite volatile in the short term due to those two indicators changing the whole time. And then in 2021, as you see it, it comes down slowly as they've taken on all the risk up front. Next one, Nigel. Yeah. So this was just, we took an example of the capital structure for the bank. And you can see in 2019, which is where a big difference comes in, the bank was so well capitalized, their payout ratio was almost 100%. I mean, you can see the capital at the beginning, then their earnings, and they almost gave all that up in dividends and buybacks. So the capital didn't actually change through the whole of 2019. Where 2020, they're now obviously they've cut back buybacks, and you can see what buybacks, how much of the capital it actually ate of the balance sheet. So just removing that is a lot of excess capital they now have. The dividends, this is just saying they won't pay anymore. They probably will. So you could probably increase that to a similar level of 2019. But if they had to stop paying, then that would be about 930 for the period. And you can just see the capital build that they now had in terms of as soon as you stop buybacks and stop dividends, then there's a lot of excess capital available for them. Nigel, you can go to the next slide. So this is just compared to 2008 and 2009, where you can see the capital destruction in 2008, which then caused 2009 to then do a rights issue at depressed multiples, which is obviously the worst case scenario and the thing we would be worried about if that had to happen. As we say, currently there's no indication of that being needed, as they can first stop their dividends and they've already stopped the buybacks. And what the Fed have done is they've allowed them certain of their capital buffers to be lowered for this crisis. So it will need to be built back, but at least it can be built back over time rather than being built back via share issues. So we think that's a highly unlikely scenario that then have to do rights issues again at these multiples, which is a big positive for us. That's all from that slide.
Right.
Then this was just taking it again and going, if we look at 2020, what type of cost of risk would it require to them actually make a loss? Our current assumptions is 3.6 billion. And we forecast about 9 billion in order to actually make a loss. And they're still not making a loss. So the 2008, if you look at what 9 billion is worth, that's 2008 and 2009 combined. And as Koki mentioned, the banks came to this with much less stress, much better position. That's highly unlikely that we get anywhere near that scenario, but that would be worst case. And then they're still breaking even. So,
okay. Thank you, Ben. You're going to touch on the Scandinavian banks, yep.
Yeah. So this is just a lot of people ask on the interest rate pressure margins going forward. It's quite nuanced as every country is different. So the US banks will take more pain now than say the European banks, as the European banks they've started the crisis at minus 50 basis points and it stayed throughout. But so we took Swedbank as an example, just as a bank in Sweden, which actually went through went into negative rates and the decreasing. And you can just look as an example on the average lending rate in 2014 was 3 and now sits at 1.8. And the ROEs, they had an anti-money laundering hit in 2020, but if we use 2019 as an example, is actually from 2014 to 2019 has stayed the same. So they've taken quite a lot of pressure on their spread, but the cost to income has stayed similar due to operational efficiencies. And then obviously, obviously lower interest rates means lower bad debt. So your ROE stays high. You diversify, so you open asset management products, wealth management products, you go to insurance, you work more on your fee income. So there are the banks, these are the biggest, best banks in the countries which we prefer to invest in. So they've always found a ways to be profitable and do the best they can. So that's what also when we invest in the higher quality banks, as they'll be able to be nimble and move into these situations where if a bank's struggling coming into a crisis, they unfortunately probably won't be as nimble and they'll take a lot more pain from the pressure of lower interest rates.
Okay, thank you, Ben. Koki, I think come back to you now just to finish off and just answer any more questions.
Yeah, no, thanks, Nigel. I hope you guys survive those technical those technical slides. But it's so important to show the number crunching, and I can assure you, we spend days on these spreadsheets and arguing with each other. And if any of you are interested in work on it, we can happily share that with you. The point we just really wanted to make, you can see that based on all the work we've done, we're quite far away from a stress situation for banks. And in fact, that come 2021, the banks and insurers will have come through it quite strongly and will be a very necessary part of the economy to help with the rebuild. Yet, if you look at this slide, the price to net asset value is the cheapest it's been on a 20-year history. So obviously 2008, US banks are quite big on the index. This is the MSCI World Financial Index. So yeah, the index spiked down a lot more because you had Bank of America and things like that were big spiking down. But on a 20-year basis, the market is back there again where it's really fearing the worst. So on the next slide, Nigel, and what we find when the market gets it wrong, and we just chose a few of the insurers and banks that we've been invested in. You can see how these companies have 20 years time consistently compounded their shareholder value growth. And in fact, the dotted line at the bottom are the MSCI World Index and the S&P Financials Index. And you can see that this is the type of company that we are trying to invest in, and we don't always get it right. Sometimes you buy something like an AIG, which isn't such a good example, but it's a different topic. But generally, we try and focus on the Renaissance Rays, the Arch Capitals, the JP Morgans, who've just got this long track record. But you can see Arch Capital is one that Barry got us to. It went from a zero exposure in March to now it's in our top 5. And you can see that huge price fall of Arch, where the market, we believe market is just totally wrong on Arch. It's a great company. You can see over the 20 years, and we're using this opportunity to actually buy that now. And so on the last slide on these three is you can see that the focus on the market has been, and I think correctly so to a certain extent, to push money more into the tech shares, because a lot of tech shares will benefit a lot and are benefiting a lot. If you just think of something like Activision Blizzard, a gaming company, and things like Tencent as well, which have directly benefited from the move to digitalization. But those things have become horribly expensive, and your banks, which are also benefiting from digitalization, have been relatively punished. So, and I think on one of the questions Craig answered as well, Tinkoff TCS is one of our, I think it's in our top 5, one of the best fintech companies, fintech financial companies in the world. And if you put Tinkoff share price next to, let's say, Naspers, it actually makes Naspers look, like child's play in terms of what that company has done. So there are a lot of shares in here where the market just brushed them with the same paintbrush and sold them down. And we think, this is where the opportunity lies.
Okay.
So you really think about what the fund gives you now. First, you get diversification. True, it is in the financial sector, although it's diversified in the financial sector between insurers, banks, debt collectors. By the way, debt collectors are really doing well now because they're buying distressed books at very low levels. And obviously the big geographic diversification. And even there, obviously, we're quite active. When we saw Bolsonaro is not playing this game right, or he's not taking the right actions, we had a very low weighting in Brazil early on, and we said this isn't going to play out well. So we sold Brazil. We added a bit to Mexico. Indonesia, we think, will come through this crisis quite well. So we keep changing the geographic split as well. And I think the most important thing is, and that's really what I've learned over the last 20 to 30 years, is we focused on quality franchises. In 2008, I had quite a few sleepless nights because the companies, whether some of the companies would make it. At this stage, I sleep very well at night because the companies we invested in are actually strong and will come through this crisis most probably better because they'll be able to buy weaker opportunities or weaker competitors. And then, a lot of growth potential at attractive valuations. So to wrap it up, really, and Barry and Craig and Ben can talk much better about these things than I do. But what we've really tried to summarize here, this comes from FactSet, the Denko Global Financial Fund versus MSCI Financials, World Financials, and then the MSCI World. And interesting that the second line from bottom, long-term debt to capital, it's actually funny that I think the first time in history, and you can see again the 2008 regulations forcing banks to recapitalize, and obviously it's a reflection of the fund as well, but the gearing in banks is almost as low as the MSCI World Index, yet the PEs are at huge discounts. The dividend yields, and this comes from FactSet, where they use a historic number, the dividend yields are high, and none of our banks or insurers will need capital. In fact, they'll all exit this with excess capital and resume the dividend payments. And you can see in terms of the price to book, it's trading at a discount to book value, yet the return on capital in 2019 was 17%. And you can see at the bottom there, Barry has done all the work just on weighted averages. Based on our forecasts at the moment, and you've heard Ben in terms of we're quite conservative, the shareholder value growth per annum over the next 3 years is 14.7%. Now, okay, one does get things wrong and etc. So make that even 10%. You're getting 10% growth in a zero rate environment at a discount to net asset value. And then you can see the re-rating potential, just very conservatively. We think there's 25.9. Could have made that 26. We're not that accurate. But there's considerable re-rating potential. But we think, obviously, there's a lot more re-rating potential. But that's actually quite conservatively speaking.
Great.
Yeah, so is the fat pitch gone? Obviously, on the 23rd of March, it was a really good opportunity. But I think you can still score a lot of fours. As I said, CAGR, compound growth rate 14.7. And if you look back to pre-2008, financials traded at 2 times book value. Now they're trading at 0.8. So a good COVID-19 experience, I think, will help the banks re-rate again. And so we ourselves have always been big investors in the fund, every person in our team, and we've certainly been loading up and telling our families to add more, and we've been using this opportunity.
Okay, thank you, Kokkie. Thank you to Ben and to Barry and to Craig also for their input. Ladies and gentlemen, thank you. Those of you that posted questions, thank you for those. I think we've answered all of them. But if you do have any further questions, you'll see my email address there. Just fire me an email and I'll make sure that the team come back to you. But thanks again for joining. Stay safe, everybody. I hope that's been a useful session, and we hope wherever you are, you have a great weekend. Okay, thanks for now.